Earnings season is almost here, and 5 major stocks will drop their reports before July ends. The big question a lot of investors have is, do you buy now and hope for a breakout, or do you wait? In this video, I'm breaking down those 5 stocks with potential to rise post-earnings, but only if the fundamentals versus the price line up. So let's analyze them together and figure out which ones are worth buying at their current price. Look, I get it. Earnings reports can feel like a jackpot moment. People love them. They sit there and say, oh, what's going in them? You've heard the hype. You might have seen a stock like Meta jump 30% after hours. Suddenly you're thinking, should I buy the next stock report earnings and cash in as well? But remember, for every Meta that's up 30% after hours, there's a Netflix that's down 20% in a single day just a couple years ago. This is exactly why you don't treat the stock market like a casino. When you buy a stock, you have to pretend that you're buying into a business. You're not betting on some ticker going up and down, flashing green, flashing red. You're buying a piece of this business. And time has proven that those who are patient and ride the ups and downs do better in the long run, and it's not even close. So in this video, I'm going to show you the 5 companies reporting earnings soon and the real reasons why you might want to own them, earnings pop or not. So let's focus on principle-driven investing, not speculation. Amazon, 4:05 p.m., July 31st, they are going to report. Estimates as of right now are revenue of $161.78 billion and earnings per share of $1.31. Keep in mind, guys, analysts will make their changes all the way up to the day of reporting. So this number that I'm mentioning now could change. Now, is it going to change dramatically? Probably not. But the point is, you've got to understand that these things do change. Now, Amazon's interesting because the company that couldn't miss on its stock up until 2021, it's only up 44% in the last 5 years. In fact, it was basically even earlier this year for the last 4 years. Now, why is that interesting? Well, the reason it's interesting is, let's go look at these financials. The reason it's interesting is in 2021, they did $470 billion. In the last 12 months, they've done $650 billion. That's a big increase. Let's go look at profit. $33 billion versus $66 billion, exactly double, yet the stock is flat. Why? Because the 4th tenet of our principle-driven investing. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. This is very popular by Warren Buffett. And what it means is the short run, we don't know what's going to happen. People are going to be emotional up and down on a stock. If they're euphoric about it, the stock will likely go up. If they hate it, the stock will go down. But what happens to the fundamentals? And the goal here is to buy when price and value are disconnected, when value is above price. That's all we're trying to do as value investors. That's it. You're trying to buy something at a discount. If you don't believe in that, what are you doing? Just stick to your dollar cost averaging then, which we'll get to in other videos and in this video. Now, this might sound obvious if you've been watching it for a while, but it's important for new folks to hear all of these metrics. So let's go through some of these metrics here on Amazon. $2.4 trillion market cap, 2.64 enterprise value. That difference is essentially their debt of $300 billion. That's a lot, especially considering their free cash flow in the last year was 20.8, which is very disconnected from its net income. So why does that matter? For those of you who are new, and for those of you who've been around for a while, it's good to repeat these. When free cash flow and net income are drastically different, you got to ask the question of why. That's usually an indication of there might be some weird numbers going on here. For Amazon, I'm not worried about that. We've all seen on their cash flow statement where they talk about their capital expenditures, look at how much they've increased. Capital expenditures were only $17 billion in 2019, $83 billion last year, $93 billion in the last 1 year. They are spending like crazy so that you can get your goods and services much faster. Jeff Bezos has done a great job of saying, I don't think 2 things will change as long as we go. People want things faster, people want things cheaper. That is Amazon's goal. Now, going back to the metrics to understand this better. One thing also, guys, we've got community members who voted on what they think. We have between hold and a strong buy here. Nobody has Amazon as a sell, but if you're in the community, you're part of our software, please go in there and vote on what you think about Amazon here by voting below. Okay, now, a couple other things here. Return on invested capital, not the best, but It's Amazon, and they're investing a lot of money and eating up that cash flow to make the business better. This is something I did not understand about Amazon years ago. They do a great job of this. Gross margin skyrocketed, 49%. It used to be much, much lower, but they're reporting different numbers now, and their profit margin is starting to inch up. Remember, Amazon Web Services is their server business, and it's high margin, and they are the leaders of the pack. So let's go look at the 8 pillars here. The 8 pillars aren't great. We got 5 X's and 3 checks. If you're Jeff Bezos, these are the 3 checks you probably want. Revenue growth, net income growth, cash flow growth. Yes, shares are up a little bit, not a big deal. Yes, the PE and price to free cash flow for the last 5 years are bad, but they're growing it like crazy. I think they're the largest massive growth machine. I mean, they're still trying to grow like crazy, and they're almost a $2.5 trillion company. That's incredible. So you got to remember that there's still potential growth in that earnings per share as they become bigger and don't have to spend as much on growth. That will happen. And their free cash flow should catch up to that. Unless, of course, they're manipulating numbers, which I doubt. But let's go see what analysts think. Analysts think they're going to double their profit and earnings per share in the next 4 years. 20%, 17, 22, 26, and 22%. It's a lot of growth, guys, for a company that big. And their revenue, high single digits, 8.9, 9.5, 10, 11, 10. That's a lot of revenue growth, going from $700 billion to $1 trillion in revenue in the next 4 or 5 years. Now, how does the story sound? The story sounds incredible, and that's what's awesome. But remember, the 5th and most important tenet of our principle-driven investing: a great story can become a bad investment if you pay the wrong price. I cannot stress this enough. This is what differentiates investors from speculators. Amazon is a great story. Amazon has a lot of great potential. If you pay the wrong price, which a lot of people got away with for a long time because of such a bull market, you can end up getting caught. And that's what our stock analyzer is here to do. Our stock analyzer is exactly here to merge the stories and the numbers together. It's really important that you make good assumptions. It's important you make low, middle, and high assumptions, because that's what valuation is. We don't know the future. We have to sit there and make guesses on what the future holds. So if you're part of our community and using the stock analyzer like it's used over 1 million times per year, you've gotten used to this. Low, middle, and high assumptions. The key there is to be realistic about those. So let's look at what I did in the past for Amazon and see if it still applies right now. I did a 10-year analysis. I did 4, 7, and 10% revenue growth. Now, analysts for the next 4 years have around 8 or 9% revenue growth, so I'm comfortable with this 4, 7, and 10 for the next 10 years. Profit margin. Now, guys, this is where it's hard, because we've seen that Amazon has a lot of potential in driving a lot of profit there. The question is, when they haven't done, 10% only happened one time in their life, and that's last year. So the question is 6, 9, and 12. If I saw somebody put 8, 12, and 16, I'd be like, okay, I could see that happening. But do we know it to happen? I don't know. That's what's hard about companies like Amazon that spend so much money on growth. You have to sit there and assume what's going to happen to that bottom line after they're done spending all that money on growth. They spent $93 billion in the last 12 months on capital expenses. That's to grow the business. What's that going to lead to on the bottom line? I don't know. That's what's hard. PE, price to free cash flow. What's it going to be in 10 years at the end of this analysis? I put 20, 23, and 26. Is it accurate? I don't know. If somebody said to me, no, Paul, Amazon's insane, it's got to be 22, 25, and 28, makes sense. I don't blame you. That's why having this tool at your fingertips is so valuable for people. They can put their own numbers in. And now I'm going to do a desired return of 9%. Now, the reason being, guys, is 9% is kind of like saying, what's the market return? What's the intrinsic value of the business based on these assumptions? But this 9% does not mean it's the price you should pay. Guys, if you're only going for 9 or 10%, buy a low-cost ETF. Don't deal with the hassle of worrying about a company. In order to buy a company, especially one you're making assumptions about for the future, put in a margin of safety. Increase that desired return. What number? Everybody's different. For me, it's about 12 or 12.5% for a company like Amazon. But let's figure out, let's hit the analyze button. The stock's currently at $219. I have a low price of 71, high price of 275, middle price of 150. So guys, it seems a little rich based on today's numbers, but I also might have been too conservative above. This is what makes investing an art. Stock number 2, Tesla. Now, we first did Amazon and talked about how Amazon stock has basically been stagnant for 4 years. Guys, Tesla was the company that everybody looked at me and said, Paul, you don't get it. Elon Musk is a genius. I'm never going to bet against Elon Musk. Guess what? The world hates Elon Musk right now. I was in California a few months ago. People with Teslas were having bumper stickers saying, I bought this Tesla before Elon Musk went crazy. Spoiler alert, Elon Musk has always been crazy. That's what makes him Elon Musk. And if you bet on a person like that, all it takes is him taking the wrong side of the aisle due to perception. The left thought he was their god. And all of a sudden they realized, oh my God, he's actually a right-winger. We hate this guy now. Now sales are plummeting. Guys, in the last 17 quarters, they've missed 9 times on revenue. It's a company that before couldn't miss. This is my point. We don't know what the future is going to hold. That's why it's important to have that margin of safety, just in case you're wrong. They report July 23rd around 4:05 p.m. And currently, the revenue estimates are $22.7 billion and 44 cents per share. Now, let's compare that to the last. Let's go look at quarterly. It's for the quarter ending June. They did $25.5 billion last June, and they're currently expected to do $22.7 billion. Hey, all you people who say it's not a car company and car sales are plummeting and revenue's plummeting. If it's not a car company, why are sales plummeting when car revenue is plummeting? Don't buy into the bullshit. 90% of their revenue, at least 85%, comes from cars. It's a car business. They tried to sell their full self-driving for $12,000. Didn't sell that well. Changed it to $8,000. Didn't sell that well. Changed it all the way down to like $99 per month with a free trial. And less than 2% of people were paying for it after the free trial was over. Where is the software business? And am I showing some selection bias here? Absolutely. But it's just goes to show that this company was the company. Look at their chart, guys. In the last 5 years was recent. But look at this chart. It was $300 a share on January 1st, 2021. $300 per share. It is at $300 per share today. That's 4.5 years later. The stock has gone nowhere. But let's look at the revenue and profit for this software business. Let's go to annual. 2021. So the previous year, because it was on January 1st, 2021, it was $300 a share. So 2020 was the year of the numbers that we had to look at. $31.5 billion. In the last 12 months, even with a drop in revenue, they're at $96 billion. That is 3x revenue. Okay, let's look at profit. Scroll down. They did $721 million that year. Last year, $6.4 billion. 9x the profit. The stock is flat. So it means one of a few things. It was overpriced back then. It's undervalued right now. Or it was so massively overpriced that right now it's still overpriced, but a lot more reasonable. We just don't know where we're at right now. For those of you who believe this is not a car company, more power to you. But if it looks like a duck, talks like a duck, walks like a duck, it's a duck. Right now, this business is a car business and should be valued as such. That does not mean you should not value a part of the business on its potential for software. You got to be careful there. Because I've done in other videos before where I talk about the numbers. Even if they had 50 million cars paying $100 per month, that's still $60 billion in revenue, which is huge. But let's say half that was profit, $30 billion in profit. That's on a company that's currently worth $1 trillion. That still is 33 times the company's value today. And they still have to get there. And they still have to get 50 million cars to pay them $100 a month. Do you see how difficult that is? We sell 17, 18 million cars a year in the US. Worldwide, about 50 or 60 million cars. To get 50 million of the world's cars on there, to buy them at $100 a month is going to be very, very difficult. But again, this is exactly where the story and the stock price is not going together because people just fell in love with the story. Guys, I've thrown a lot at you, and we still have 3 more companies to do. If this feels overwhelming, I get it. It will. But we're here to simplify all of this. I'm not trying to talk about big words and things like that. My biggest issue is I speak a little quickly. feel free to rewind because this is really, really important. And I assure you that if you take the time to watch a few videos and understand this, you will probably be better than 99% of the world in investing and understanding financials. Now, we have 17 community members who voted on this thing. Strong sell all the way to a strong buy. And the biggest one is a sell. Guys, who knows? This company has defied the odds for a long, long time. But now are things starting to catch up? I said years ago that I think Tesla would be one of those companies that we'd look back on 20 years from now and the stock might still be selling for less than its all-time high that it reaches now. Is that a bold statement? Yes, it is. But that has happened several times in history. This is happening on two companies from 25 years ago, Intel and Cisco. And Intel is struggling right now, but guess what? They have more revenue today after falling 30% in revenue than they did in 2000. Cisco has way more revenue today than it did in 2000. The stock is still lower than it was at its 2000 peak. So let's go to the 8 pillars, which right here, 4 checks, 4 X's, valuation metrics, 228 times 5-year free cash flow, and 127 times the last 5 years earnings. Shares outstanding up slightly. Returns on capital are getting better. This is actually pretty good for a car company. And revenue's up, net income's up, cash flow's up over the last 5 years and up a lot. So what do analysts think now? Have they adjusted? Guys, look at analysts. $2 a share in profit going to $9.73. That's 4.8 times more profit 4 or 5 years from now. That's incredible. They think that Elon's still going to turn this thing around, and he very well could. But guys, call it $10 in profit, it's still selling for 30 times profit in 2029 today. Revenue? Yeah, they have a decline in revenue this year, estimated. It's looking a little worse than it's supposed to be. And back to growth, double-digit growth for the next 4 or 5 years. So can Elon turn around this reputation? That's the question. So let's go to our stock analyzer tool and put this all together because the story has absolutely changed on Tesla. Guys, I'm going to show you my numbers here because what I'm doing here, I love because it just shows the real story on Tesla. I did 10, 15, and 20% revenue growth on Tesla. Guys, they're declining their revenue right now. So for 10 years from now to see this kind of growth would be insane. Profit margin. Guys, their highest profit margin, 11%. I'm doing 12, 18, and 24 on free cash flow and profit margin. These are all significantly higher than they've ever hit. This assumes that part of this company is software. Please remember this. I am putting the rosiest of rosy assumptions here. PE, price of free cash flow, 17, 21, and 25. And again, my 9% intrinsic value return, no margin of safety. The stock's currently at 300. Hit the analyze button. I have a low price of 91, high price of 525, middle price of 233. And guys, keep in mind, my middle assumption on profit is 18% bottom line. You know how scary that is? Let's go look at their gross margin currently. Their gross margin before paying any overhead, before paying any operators, any factories, any taxes, 18% right now. And I'm assuming it's going to be 18% to the bottom line, which they've averaged the last 12 months has been 6.7, the last 5 years, 11%. This is a tough, tough situation to be in. Is it possible? Yes. Is it probable? That's the question. Stock number 3, Southwest Airlines, a company that I currently own. Don't ever buy a company because anybody in the world, even Warren Buffett, owns it. You were here to teach a process. And they report earnings July 24th at 6 a.m. Estimated revenue of $7.3 billion and 52 cents per share in earnings. So, company has been beaten down. And guys, I'm going to tell you right now, we have 14 community members who have it as a hold. And it's a play on profit margin. Let me show you why. Right here, their profit margin in the last 5 years is negative 0.65. Last year was 2%. Before COVID, they consistently got 10 to 15% profit margin. So my play here is that they're going to get back to somewhere close to there. Is it going to be easy? No. Has it already been tough? Yes. But you know what's interesting? Their revenue is growing. Even before COVID levels, their highest revenue was $22.4 billion. Last 12 months, they've done $27.5 billion. They need to convert this to profit. And they've gone through a lot of computer issues, customer issues, 737 issues, a lot of things at once. I believe this is part of an opportunity. Am I right? I don't know. We'll find out soon. Let's look at the 8 pillars here, and they don't really tell the real story. We have 6 X's here because everything's garbage. But you know what I love? They're buying back shares with the limited cash flow they do have. They're sitting there saying, we think our company's undervalued and the stock has been beaten up. Let's buy back some shares. Everything else, an X. But guys, this was an airline that was not an airline. It literally sat there and it was the anti-airline. It made money consistently over 48 years up until COVID, or 54 years, something like that. It had never lost money. They properly hedge their fuel, and they stick to one plane and cost-efficient and cost-effective routes. That's it. They keep it very simple. Guys, again, I need to slow down. People will miss the big picture in all this. So when I buy a company, I look at it as, okay, I never look at my accounts. Like even when I log in to sign something from my Merrill people, I block my balances. Because even though stocks are up a lot right now, I don't want to fall in love with that number. And if stocks are down, I don't want to get upset about that number. Because when you buy a business, you don't get to see what it's worth every single day. You just focus on revenue and profit growth. And over time, it generates a lot of wealth. I want you to be the same way with stocks. And that's difficult. I get that. But this is where we have to look at it. I want you to get the point where you look at a company and say, okay, where's this company going to be 10, 20, 30 years from now? Is it going to be more profitable, less profitable? But most importantly, can I pay a reasonable price today to get a good return on my money? That's all we're looking at here. It's simple, not easy. This is what's important to understand here. And I want you to remember that big picture. Let's see what analysts are saying about the company. $1.18 this year in earnings per share, growing to $4.25 in the next 3 or 4 years. Okay, a lot of potential there. Revenue, kind of stagnating at $31 billion. I don't know where they get that from, but maybe it is. I look at Southwest going, I think they're going to probably grow revenue 3 or 4% a year, maybe 5. It's a good company that people have a lot of attachment to. Are they changing the way in which they do business? Yeah, but I think for the better. So this is a very simple story for me. What is the future of Southwest when factoring in this bump up back in profit margin? That's my full play here. So I did 2, 4, and 6% revenue growth. I did a profit margin of 8, 11, and 14. And remember, before COVID, they were consistently doing 10 to 15%. So even my high side, I feel is reasonable. PE, 14, 17, and 20. I'm being a little conservative, even though, guys, look at this. Their return on capital over the last 10 years is 8%, with 5 years of that being negative. So really, their returns on capital were about 15%, which is insane for an airline. For those of you who don't know, or for those of you who want a reminder, returns on capital is a metric you have to look at to see if a company deserves a premium. What it means is when they invest money in their business, what return do they get on that capital? An airline, it's hard to get 15, 16%, and they do. They did for a long, long time. The question is, can they get back to it? And finally, I did my 9% desired return. And this is where I think it's going to shock you guys. Hit the analyze button. This is where I think there's a lot of potential. We have all green here. Low of 52, high of 152, middle price of 92. Guys, I don't know how Southwest is going to do. It could end up being a complete dud. But if I had 30 companies I could buy with these kind of numbers, I would crush Warren Buffett. Stock number 4, another company I own, PayPal. Reports July 29th, 7 a.m., estimated revenue of $8.08 billion, earnings per share of $1.30. $8.08 billion. Let's see. How does that stack up for last year's $7.9 billion? So not a lot of growth. This is not a growth company anymore. And when it was perceived to be a growth company, this is where the stock went. Remember, stock price a lot of times will be backward looking. It's supposed to be forward looking, but they'll sit there and say, oh, growth. Oh, shoot, growth isn't happening. Stories change. Let's move on. The question is, has the price changed enough to make it attractive again? Because that 5th pillar is very important. And I want you to remember, it's not about just the price you pay. It's what you're buying for that price. That's the super important aspect here that any investor needs to understand. Now, community members, we have 37 community members who have voted on this stock. The average of the buy rating was 60 and 30%. So basically 90% have it as a buy or strong buy. Boy, I hope we're right. So some metrics here to look at, guys. Look at this. $6 billion in free cash flow last year. 5-year average of $5.2 billion, which is higher than their net income and 5-year net income, which is great. Revenue last year in the last 12 months of 31.89. So they're basically sticking along there. Profit margin very consistently in the 14% range with that gross margin of 46%. This is their growth rate in revenue, 7.3 for the last 3 years, 11.8% a year for the last 5, 14.5% for the last 10 years, with about $6 billion in acquisitions, which is pretty hefty. They own Venmo. PayPal is a very secure source for payment. Is there competition? Apple Pay, I don't think is a competition. Amazon Pay might be. I don't think Apple Pay is. Apple Pay is merely on your phone just with your credit card as a way of saying, ding. With PayPal, you get the support of PayPal if you buy something you don't like. If you buy something through Apple Pay and you have an issue, you have to go to Visa or American, whoever you bought it, whatever card you bought it with. That's a very different aspect there. Now, let's go see what the 8 pillars look like. 8 Pilla Thrilla. Everything is a check here. They're buying back shares. They have cash flow growth. They have net income growth. They have revenue growth. They have reasonable debt, even though they have a lot of debt, by the way. They have $50 billion in debt. And market cap of $75 billion, enterprise value of $125. That in-between number is but a lot of that money is that is the money they owe people because they have money in their accounts and they're holding at any given time. 14.5 times their 5-year free cash flow, and it's getting better. It's 12.6 times free cash flow right now. Guys, this was a stock that was 310, everybody loved, and then at 50, everybody hated. This is the world of investing. The question is, who's right? That's what we have to ask ourselves. Let's see what analysts think. Well, analysts see steady earnings per share growth, 11%, 11%, 13.5, 10.5, 16.5. That's a lot of revenue, earnings per share growth for a company that people think is dying. And look, revenue growth, 3, 5.5, 7.5, 6.5, 4.5% revenue growth in the next few years. Not great, but they're becoming more and more entrenched in people's lives, and that's what makes it better. So let's go look at our stock analyzer tool here and see what a reasonable price to pay for PayPal would be. Okay, so I did 3, 6, and 9% revenue growth. That's actually quite a bit. I'm gonna actually pump the brakes on that one a little bit. I'm gonna go 3, 5, and 7. I'm adjusting this. Now, profit margin, I did 13, 14.5, and 16. And guys, look at this. Their free cash flow is a lot higher, 18 to 20%. I'm doing 16, 19, and 22. So I'm gonna focus on the free cash flow number. PE, there's a lot of competition out there. I'm putting 14, 17, and 20, even though their returns on capital are getting better and better. The last 10 years, it was 9.5%. Last 5 years was 10.5. Last 1 year is 13. As this number gets better and better, it says they're doing better about investing their capital and they're building that moat. That's what's really important here. And companies like that deserve a premium. I'm not even putting a huge premium here. And finally, my 9% return. But before we hit that, guys, we have analyzed 4 great companies. But a part of me doesn't care how great the business is as much. I'm not just going to pay any price for it. If all that mattered was buying a great business, then we would just buy all the best businesses and say, okay, whatever price doesn't matter. But that's been proven time and time again to not work. That's not how real investors build wealth. You need to understand the business, understand valuation, and have a system that works no matter what the market's doing. As recently as April, we saw that big market drop in early part of the year, ended in April. Fear was all over the place. Headlines went nuts. Most people froze. I got excited. While everyone panics, we have a plan that we stick to. We know exactly what we're looking for, and we load up on the stocks that make the most sense at those prices, knowing full well they could go further south. But the Paul of 20, 25 years ago, I was just like the average person. I would chase stocks, follow tips, get caught up in the hype, believe the story is what matters, hoping something would stick. That isn't investing. That's gambling. And this is exactly why everything money was created. We needed to give the people like me from 25 years ago the tools and the strategy, and I wish I had that community of people to talk to. What we're trying to do here is make it an easier life for you. We're trying to make it easier so you can understand what you're buying and why you're buying it, so that when the market does turn, which it always does, you're able to say, this is what we planned for. This is what we're ready for, and embracing it. In our community, the number of people who get excited on big red days is incredible. So do yourself a favor. Join Everything Money. It gives you access to all the software, all the private groups, like-minded investors who are trying to eliminate the guessing game. Now, what's really important though is don't join if you're the kind of person who jumps from one shiny thing to the next. If you're looking for a quick fix, you shouldn't even watch our videos. If you're interested in learning and getting better And we did a poll recently in our YouTube community. Over 2,000 people responded. And we asked them, what are you here for? And 86% were trying to get better and trying to learn a better process. That was incredible. It wasn't trying to make up for lost time, even though that was a part of it. But trying to get better was truly important to them. And that's exactly what the community tells me. We have the right people watching our channels. So if that's you, click the link below, start your 7-day trial. Just know that spots are going to be limited, and we're trying to change it to even becoming an application process. But if you're serious, now's the time. Now, we did this analysis, hit the analyze button. The stock's currently at 75. Guys, I have a low price of 60 to 75, high price of 126 to 175, middle price of 89 to 116. And that's after lowering my growth assumptions for the stock. So we're at 15.5% return based on the middle assumptions if everything above happens. It's pretty solid. I feel like the juice is worth the squeeze for me. Now for our final company, this is a company that has been on a roller coaster ride over the last 30 years. AMD, Advanced Micro Devices. And for a long time, guys, this company took this company, its 2000 high was around $45 a share. It took until 2019 to beat that high again. 19 years. Now, their estimates for July 29th are $7.42 billion in revenue and 49 cents earnings per share. This is a chip maker. They've been riding that chip wave. Last year, same quarter, they did $5.84 billion in revenue. They're expected to do $7.42. Big time jump. The company is worth $224 billion and has an enterprise value of $230. That's $6 billion difference. And look, their free cash flow is almost $3 billion. They have very little debt. But guys, I look at this and I think, first off, great growth with very little acquisitions. 3-year growth per year, 13.5%, 30.5% over the last 5 years, 18.5% in the last 10 years. But guys, price of free cash flow of 81, PE of 100. That's a lot. That's a lot. They did revenue of $27 billion. Guys, Intel did revenue of $60 billion or something like that. I don't know the exact number, and they're worth like $60 billion. At some point, you're paying too much for growth. The question here, is that the case? So let's go to the 8 pillars here. 4 checks, 4 X's. Valuation. Guys, look at this. They've increased their shares outstanding by 32%. This is massive dilution. This takes away a third of, or half of the growth the company's experienced in the last 5 years. This is something very important, especially if you're new to this channel and if you've been here for a while, repeat it over and over. When companies are issuing a lot of shares, they're giving you less and less of the business. If a company has 10 shares and you own 1, you own 10% of the business. If they increase the number of shares to 15, you still own 1 share out of 15 now. You only own 6.66%. You've been diluted by 1/3. These people have been diluted actually by 1/4. That's a lot of dilution for such a big company. But I don't blame AMD. They're like, listen, people are crack addicts. They want our freaking stock. Let's give it to them. Analyst estimates. Big growth. $4 per share going to $11 per share in the next 4 or 5 years. Big time growth. And revenue growth, really high. 23%, 17, 16, 18, and 9%. That's a lot of growth for a company of this size. So, stock analyzer. I did 10-year analysis. 8, 12, and 16%. That's a lot, guys. Profit margin. I did 8, 15, and 22. They've never hit 15 in the last 10 years in terms of an average. Okay. PE. I did 18, 21, and 24. What I like here is, even though the ROIC is low, 1.82, it in the last 10 years is negative 5.83. 5 years is 3.93. So it's getting better-ish. This is probably a fluke year that happened 1.82, but it is getting better. And again, my 9% desired return. Hit the analyze button. Boom. Guys, we have a low price of 34, high price of 215, middle price of 97. Huge range because there's a lot of range for AMD because they haven't performed so great in the past. Guys, if you want to understand, and if you're still watching right now and you're not looking for hype, you're here to learn how to build wealth. So why stop now? In the full course, just click the video linked on the screen. I show you exactly how I find undervalued stocks before the crowd catches on. You're going to learn how to read financials the right way, avoid overpriced traps. And guys, you'll be in the top 1% of knowledge on financials and investing. So if you're serious about this, click the video on your screen and take the next step. Thank you for your time.